It's time for the Your Personal Bank Show with Ferenc Toth, President and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome, everybody. This is Ferenc, and we're going to talk about a lot of great stuff today, including how to gain control of your money, create tax-favored income, and have more access to more funds over your lifetime. So we're going to cover 3 of the major problems that I run into. I've been doing this in the financial industry for 22 years, meeting with clients, talking to them about their money, how to manage it, how to maximize returns, how to minimize risk, how to minimize taxes, all that stuff that we all want. And the reality is what our mission is to dramatically enhance the financial trajectory of individuals, businesses, and families. And our primary focus, of course, is with entrepreneurs, investors, and professionals. So, we're talking to the right people. And the thing is, how we do this is we work with a lot of strategic partners. I work with all types of different attorneys, tax, asset, estate planning attorneys. In fact, I'm excited. Estate planning attorney I've been working with for over 15 years is going to be a guest on our show coming up. CPAs, you name it, so that we can help people, again, gain control of their money. That's one of the big keys. And the last thing before I really jump into this I want to share is I want to give a shout out to my friend Colin Egglesfield. I was up in Chicago meeting with him and a number of his friends, and we did a personal bank workshop and shared with a lot of great information to dramatically enhance their financial futures up in Chicago. So much so that they asked me to come back in November and share some more. So Colin, it was a great time up there. And by the way, Colin Egglesfield is actually quite a successful actor in movies, TV. He was on the client list, Melrose Place, All My Children, many others. And he actually started a real estate investment firm in South Chicago, rehabbing properties in that area, working with nonprofits to revitalize those areas. And what's really exciting and cool, in fact, Colin, Saturday, I think it was, yes, took me to one of those properties that they were working on. And they're making a difference in the neighborhood. And what was really neat about it is Your Personal Bank is part of the tool of allowing him to be able to do this. So it's a pretty neat thing. So, Colin, thank you for allowing me to come up there, inviting me. And by the way, he just wrote a book, as I mentioned, named The Agile Artist. So check it out. And his latest movie, he co-starred with Sylvester Stallone. Hasn't come out yet, but when it does, we'll let people know. So exciting, fun time we had up in Chicago. Now let's talk about your money. So the reality is I've been talking about, again, your personal bank, introducing the idea, the concept, and things like that. But first thing I want to touch on is one of the major problems that we run into on a constant and regular basis with people. And that happens to be debt. And I get asked a lot about debt. There's a lot of people out there that talk about and teach getting out of debt, for example. There's famous names we all know about. And we get questions about things like, should I pay my house off? And all those types of different things that people are always asking questions about and don't really know where to go to get the answer. And I always tell people, folks, this is the thing. When it comes to debt, the key thing you need to understand is you need to understand the difference between strategic debt and consumer debt. There's a huge difference between the two. And if you think about this a minute, just take a sec. What's the difference? Well, here's the difference. See, strategic debt is sometimes known as good debt. And what I mean by that is good debt is debt payments are made from someone else's effort. A great example that's familiar to most people is a rental property. If you own a rental property and someone else is making the mortgage payment and your cash flow is positive, well, that can be good debt or strategic debt. Certainly you can create wealth using strategic debt. In other words, you're in control of it. You're mastering it. It's not in control of you. Now, consumer debt, what's the difference? It's really quite simple. If you have to go to work, and I don't care if you own the business or employee, doesn't matter. If you have to put out your effort, time and effort, blood, sweat, and tears to pay off that bill, that's consumer debt. And why is this so important? Payments that are made from your efforts can be a problem if something happens in the future. Have you ever lost an income? Have we ever had a business failure or reduction of income or lost a job or the economy took a dive or any of those scenarios, or you get sick or hurt and can't work, any of those scenarios that ever occur that happen in life, that's real world. This is what happens. And you have this consumer debt. Do those payments stop? No, they just keep coming. Those bills, those monthly bills keep coming. And when you can't pay them, well, you get the nasty letters, final notices, all types of things. And what all that does is it creates stress. See, I'm a financial guy. I'm a money guy. I've talked about this before. I'm really an entrepreneur. As the intro shared, I own a business. I own a financial agency, insurance agency. I've in the process of starting a bank. We're looking to open a bank here. I've owned a real estate investment firm. I've owned a retail business. I'm a serial entrepreneur, I guess you would say. And I've started 4 companies out of the 5 that I've owned over my career. And the thing is, as an entrepreneur and as an individual, I learned the hard way, like most people, about debt, the power of debt, where it can enhance and leverage and accomplish things for you, but also the ugly side of debt, where it can really come back and burn and hurt you. Here's the thing. According to the U.S. Census, the average American with a college degree earns $1.8 million in their lifetime. Okay? And people say, why do you talk about debt? Well, you're going to see in a minute whether your personal bank can help offset or reduce your total debt payments and take control of that money instead of paying interest. Start earning interest rather than paying. So the average American earns $1.8 million, according to the U.S. Census, so with a college degree or higher, in their lifetime. And according to Credit.com, the average American pays $280,000 of interest in their lifetime. Not principal, interest. That's a lot of money. And people say, why are you talking about debt? It's it's not a big deal. A few $100 a month here, a few $100 a month there. Guess what? It creeps up on you. It's over $250,000 for the average American in their lifetime. Now, if you think about that a minute, that's about 15% of the average person's total gross income. Go into work tomorrow or your business and find out you just got a 15% pay cut or income cut. Are you excited about that? I'd venture to say most of us are not. But yet what's happening is we're voluntarily giving that 15% to the lending industry. Remember, I said I'm on the chairman of the board of a bank in formation. I understand the lending industry, okay? They're doing just fine. Don't feel sorry for them, okay? They're doing great. They're taking a portion of our hard-earned dollars, our blood, sweat, and tears, and making money on it, and we're voluntarily giving that over to them. See, the key on this is recapturing. You want to learn how to recapture a portion of the income stream that's leaving your pocket as we read this. And here's the quick thought. This is powerful. We all have a checking account. And we have money that flows into that account, and we have expenses that flow out. And hopefully most of the time, we have more going in than coming out, right? Well, do you earn interest on that flow? The answer for most cases is no. Does the bank? Of course they do. What they do is they take that flow of money, and they take it and loan it out for cars, houses, credit cards, whatever, and create interest. So here's a common in situation I share with people all the time is if you captured $30,000 monthly business income, gross, that's not a huge small business, in 18 years you could capture $1 million of tax-free retirement money for you. We're going to share some more information about debt and how to reduce this when we come back, but this is the Your Personal Bank Show. Tune in on Tuesdays at noon on Money Radio.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Okay, everybody, we're back, and we were just talking about how to capture interest instead of paying it on debt that the average American pays over $250,000 of interest in their lifetime, according to Credit.com, and why not capture some of that interest? Here's the thing. We're voluntarily giving that up. through all types of debt instruments, houses, cars, credit cards, whatever it is we're doing, and we're paying that interest to someone else, a lender. They're taking that money and investing that money and making more. So they're not taking it from us. We're voluntarily giving it to them. And unfortunately, in most cases, it's either due to emergencies because we don't have enough cash flow, which I'm going to address here in a minute on how to absolve that problem, or, lifestyle. And the thing is, that doesn't move us forward financially. And when we have situations where we're unable to make the monthly payments on consumer debt due to many times things totally out of our control, the economy, job, business income, whatnot, disability, you name it, guess what? We have a lot of stress in our lives and bad stuff happens. So we want to avoid those kind of things and eliminate stress because that's the number one thing that having not enough money does. So how do you capture some of that interest that you are giving away voluntarily? My question is always, hey, it's over $250,000 per person. A married couple, that's over $500,000 in your lifetime. What if you could capture a portion of that? Could you use an extra $100,000, $200,000, $300,000 for retirement? I think that answer would be affirmative for pretty much all of us. So the bottom line is, it's your personal bank. This is the solution of how to accomplish capturing interest. Now, a nod to my compliance folks out there. I always love to say this. This isn't for everybody, and not everybody's going to do this. But here's the thing I want you to understand. If you have not looked at this, truly looked at this, do yourself the favor and do so. It can make a massive difference financially in your life. So how does it work? Well, if you're going to operate a bank, a personal bank, you have to think like a banker, understand how banks operate. I've shared this before, but I think this is worth repeating. It's so powerful to understand. Thinking like a banker versus an investor is simple. Investors, which is what we're taught to do, we're taught to trade hard-earned dollars for assets with the expectation the asset will increase in value over time, and typically focus on the potential gains, many times creating little or no cash flow, and rarely ask, what's my recourse if things go wrong? What's the downside protection, or the plan B, if you will? And see, the problem with investing, for most investors, is if you purchase a stock, a piece of real estate, or a business, can you tell me what it's going to be worth in a year? And the answer is no. You can look at charts, you can guesstimate, but we don't really know, do we? And again, this is not from me. This is from several different various sources and books. Investing primarily for appreciation is just another form of gambling. It is, if you think about it, because if your only way of making money, if it goes up, and if it goes down, you lose, how is that any different than going to Vegas, for example? So that's the issue with investors. Now, how does a banker operate? See, the banking industry, here's what you need to understand, is more risk adverse and looks at risk on money probably more than any other industry that's out there. So we can learn from them. Again, you can love banks, hate them. I don't really care. That's not what's important. We can agree they're savvy about money, and we can learn from them. So I always say, look, have you ever taken a mortgage or a car loan? And when you signed the papers, you knew you'd have a payment, right? Did you plan to make the payments? Well, of course you did. You wouldn't have signed the papers otherwise. And guess what? The banker knows that too, because you went through a whole approval process, didn't you, to get the loan in the first place? And if you had not made those payments, what would have happened? Well, they would have taken the asset, resold it to somebody else, and created payments or cash flow from them. So is the banker really risking their money? Typically not. Okay? Collateralized loans very, very seldom lose money for the lender. So the bottom line is, how does your personal bank work? Well, when you get a check, what's the first thing we all do with it? We deposit it in the bank. What's the bank do with our deposits? Loan it out for compound interest. So do what banks really do. Let's say you walked in the door and you wanted to open an account, and you gave them some money, and then the next person walks in the door and wants a car loan. Does the banker take the cash you just gave them and turn around and give it to the car loan person? And the answer is basically no. What they do is they take your cash, stick it in the safe, and they can borrow against that cash, that asset, to create interest, payments from someone else. Okay? That's how banks operate. Can you borrow against an asset? Well, yeah, we do it all the time. Cars, houses, credit, 401ks, whatnot. Okay, do what the banks do. They don't invest in the stock market. I'm talking the banks. They earn compound interest on their deposits. That's what they primarily do. And they borrow against the cash they hold to earn more interest. So can you. Access to funds and allows you access to those, but yet gives you the long-term, say, supplement to retirement income. See, the problem is when you access an account, a typical account, when you take the money and you pay off bills or you invest it in something else, you do something else with that money, what happens to the funds that were in your account? The future growth on those funds, I should say. It stops. Here, you can actually have the opportunity to access some funds, return it back, and not lose that ongoing compound interest, that compounding factor that we've talked about before, but we all know is super powerful. You understand compound interest basically is 1 to 2, 2 to 4, 4 to 8, and so on. And the rule of 72, which is very familiar to most people, is at 7.2% interest, money doubles every 10 years, okay? The bottom line is this: if your money is growing consistently over time and you don't take access from it, you don't take withdrawals, you're going to gain compound interest. And many people have called compound interest the eighth wonder of the world. So it's definitely something you want to work for you. Let's give you one last thought about the debt, like I talked about in the first segment. Compound interest, by the way, works both for you and against you. What do I mean by that? Well, if you have a debt and you're making minimum payments or even no payments on it, what is that debt doing over time? Compounding. So compound interest can hurt you equally as much as it can help you. So you want to be on the right side of it. You want to capture the interest on your money, have access and use of it, I should say, when you need it or want it for opportunities or emergencies, whatever that may be. Plus, have it down the road long-term to supplement retirement, for example, or pay for college or any other, or supplement your business or any other use that those dollars long-term are going to do for you. That's what the Your Personal Bank does. So the tool we're going to use to make this work, well, we use an insurance tool. Not the type that you're familiar with. Most people are not. It's a high cash value type product that typically corporations, banks, those types of things use, okay? It's not the type that's typically used by the average individual. And why do we use it? It's real simple. Compound interest. We want increasing cash flow. We want money growing every year. We want no risk of loss. We don't want to access or borrow against an asset that can lose value, so anything market-related gets knocked off the table. We want liquidity. We want access to funds if we, again, want them or need them. And by the way, I'll talk about there's 3 different ways to access funds in these personal bank contracts. It's really cool. And, of course, we want tax-favored growth and pass it on to the heirs in a tax-favored manner. There is only one financial tool that basically encompasses all of these characteristics. Now, for it to work, some people, like I was in Chicago, I mentioned last week, who had looked at this idea, and I've run into people who say, hey, I can access funds against a policy, but here's the thing I want you to understand, and I'll touch on the next segment, the difference. Most of the time when you look at these contracts, there's little or no money available in the first few years. So yes, you can borrow against the contract, you could access funds, but you can't touch it for several years. And I was showing a difference, a significant difference, where you could access a significant amount of funds, either again through the policy, as collateral for a loan, a traditional lending, or you could even sell it down the road. The bottom line is it has to be structured properly. There's specific riders that are used that are at no additional cost, and it has to be accessed correctly through the policy loan provisions that have to be available in the contract. Also, depending on funding, there could be limited access to cash values in the future. Obviously, the more you contribute, the more you'll be able to access. That's the bottom line. We're going to go into this a little more detail in the next segment and show you how to know whether you have the right tool or not. Tune in Tuesdays at noon on Money Radio for the Your Personal Bank Show.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. All right, we're here to talk about your personal bank. We're talking about money. We're talking about how to have access to more dollars, how to capture interest instead of pay interest, and create tax-favored income all in one fell swoop. So as I've been explaining, as far as how your personal bank idea works in terms of taking control of your money and having access to those funds to use short-term needs when you have emergencies, life happens, right? Or you see opportunities. In fact, and then also build it for long-term, not lose the compounding effect of the money. You can operate it that way where the compounding for long-term, tax-favored retirement income can be created all at the same time. It's really an awesome combination and a powerful tool, as we put it, if you combine it, both sides of it, and use it effectively. So the bottom line is this. Really what we're trying to accomplish here is this. One of the main keys, I've shared a couple of key financial concepts for financial success, okay? And one of them I've been talking about for quite some time now is thinking like a banker versus an investor. Protect the downside. Have some risk-adverse strategies with your money. There's another key financial concept in terms of financial success. We all know it, but I'm going to define it, and you're going to understand it better, hopefully. And it's this. Access to capital is huge in terms of key for financial success and reducing stress. Here's what I mean. Whether you're an entrepreneur and you work with money with your business, or you're an individual household has a budget, if you will. It operates like a business. You have income, you have expenses, just like a business. You want to think of it in those terms when you're balancing the checkbook, paying the bills, whatever needs to be done. Having access to capital is the key to taking advantage of opportunities when they present themselves. We've all had that happen. We're going along in our daily lives. Something happens. We see an opportunity. We just know in our bones that this is a good opportunity. This is something that you'd like to be a part of, that if you could put some money into it, you're convinced it's going to be something that's going to be turn into something great down the road. And if you've just suffered some type of financial setback or your funds are limited, that can be extremely frustrating. And in fact, businesses often fail because they're unable to take advantage of those opportunities. Things when they come up, can they take advantage of that opportunity or not and move to the next level and succeed with that business? When you're thinking about yourself individually or household or whatever, it's the same thing as far as being successful long-term and creating that retirement income so that you can enjoy the golden years and such and take care of your family. Opportunities present themselves. You have to have money available to do it. And when you don't, or if you do have the money and there's significant penalties, tax consequences, various things like that, to access those funds, that can discourage or eliminate that opportunity because the cost of getting the money is too great to try to take advantage of the opportunity that presented itself. The flip side of the coin is when bad stuff happens. So that's when good things happen. What about the bad stuff? I mentioned it earlier. Economic downturns, job losses, income losses, medical issues, various things, emergencies. Those things happen in life. And we have needs for money at those times in our life, too. That's why, financial advisors for the ages say have, 6 months, maybe a year of reserves, cash reserves set aside for those emergencies. So in case the roof leaks or the car breaks down or whatever, you can handle it. You can take care of it. It's sad. There's all types of studies out there where the average American, if they lost a paycheck or two, they would be in financial dire straits. That's no secret. Most people know that. Having that cushion, having that reserve is a key to financial reduction of stress. My wife, I shared this before, but we've been successful in our lives at times, and we've had times in our lives where things weren't going so well. We personally invested in a lot of real estate in Phoenix, and starting in 2001, and we all know what happened in 2008, 2009. It was not fun. Also had a business. I've owned several businesses, been very successful with some, have had some situations, of course, over the years with others. And the reality is, my wife said something that was so interesting. She goes, money doesn't make you happy. She's right. But what it does do is it sure gets rid of a lot of stress. So when you're dealing with those emergencies of life, but money's not a problem, it's easier to handle those, or it's one less thing to deal with. I'll put it that way. Okay? Having access to funds is key. So your personal bank, where you have access to funds myriad different ways, we'll explain that further, how you can access funds here, is key. It's powerful to make sure you take advantage of those opportunities or don't get hurt by those emergencies in life. Now, my challenge is this. When I say to people, you want to look at life insurance as a financial tool to grow cash and all these things for short and long-term purposes, I have people that'll stop listening at that point, and they'll think, well, they view insurance as an expense, not as a financial tool that can become an asset, that can grow cash over time. And they stop listening and they miss the whole point. This is not what we're talking about. And there's basically three different types. There's a fixed, there's an indexed, and leveraged options. Fixed is what it is. Sounds like it's consistent returns. It has guaranteed and insured type of return. The steady Eddie, if you will, as I call it. And, these days, historically, these days 5-6%, depending on the company, is what they're paying. Historical averages have been in those ranges, 5.5 to 6.5, if you will. Index, of course, returns are based on the S&P 500. Most often, an index, typically S&P. The nice part is, those bad years, you don't lose, and so there's no downside market risk on the bad years. In most cases, most products, you can make a nice double-digit return in the good years, and don't lose in the bad years. What do they do? What's the trade-off? It's really quite simple. There's caps, and they cap the upside. Some do, some don't, or there's a fee. They either make their money through the fee, or they take a piece from the cap and apply it to the downside to protect the downside. The average on those kinds of things, 6.5, 7 over the last 20 years, depending on the company. That's pretty straightforward. And like I said, if you have questions on that, we can send you some information on that. Contact us at yourpersonalbank.com. Be happy to send you additional information to show you these numbers. Right now, I just don't have the time on the radio to delve into it. But if you want more information, we can send it. This is interesting for those that are familiar with and comfortable with leverage in their life and their business or those types of things. If you want to find out more information about how the leverage option works or any of the options, contact us at yourpersonalbank.com or toll free 866-515-6280. Be happy to chat with you and see if this is a good fit for you or not. We'll talk about one more piece at the next segment. You're going to love it. Stay tuned.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, everybody, we're rounding third. We're in our last segment, and we've been talking about lots of fun stuff like money. We've been talking about debt, how to reduce debt, how to capture interest rather than paying interest, how to use the Your Personal Bank tool to capture some of that interest. And we also talked about a very powerful financial success tool or key, knowing that you have access to funds for opportunities or emergencies gives you the opportunity to make more in the future, do better, and or eliminate the stress or reduce the financial stress on those emergencies in life when bad stuff happens. Have access to funds, and you want to have ready access to funds without significant penalties, taxes, or various other things that can prevent you from having access to those funds. And then on top of it all, you could have access to those funds for a while as you needed them for that opportunity or that emergency, yet not lose the compounding that you would get long-term if you had just left it in there. Now, I'm going to talk about that further, how to access funds, yet maintain the ongoing power of compounding. Again, compound interest is the eighth wonder of the world. It's often been referred to as that. And the thing is, on any traditional type of account, of any kind you can think of, any financial tool, you take money out to take advantage of an opportunity or pay for a bill or expense or an emergency, you lose the effect of compounding. And remember, compounding goes 1 to 2, 2 to 4, 4 to 8, and so on. You don't want to be going from 4 to 8 and lose that compounding effect. So I mentioned there's 3 options in terms of what type of financial tool we use as far as the insurance tools go. There's fixed, there's index, there's leveraging. They all have the right place for the right fit. Oh, and you know what? I got to back up a sec. This is one of my pet peeves. You hear this a lot out there where somebody will say this is bad or that financial tool is bad. Here's the thing that you really need to understand. What you're hearing is that person's bias. For them, it might be bad. The thing is, all these financial tools that exist, and I'm talking about all of them across the board, in terms of the entire financial universe, are designed for specific purposes. Now, granted, there's better versions than others. There's different companies that offer them. There's competition. We all know that you can get different quality tools. If you buy a hammer, you can buy a really high-end, nice, professional hammer. You can get a basic one. Okay, we all know that. But the reality is the hammer is designed to drive nails. It's that simple. But here's the thing about financial tools, and particularly in the insurance world. There's 2 ways to really structure, whether you take the fixed index, leverage options, whatever it may be. There's really 2 major ways to structure these. One is to maximize cash. And it's radio. I need you to take a second, if you could, and picture in your mind a teeter-totter. And you've got cash on one side, you've got death benefit on the other. And a lot of people, a lot of advisors, agents, and whatnot, are not aware of the range of how much this teeter-totter can change from cash to death benefit. In other words, are you trying to maximize cash, or are you trying to maximize death benefit? A tool, a product, is going to be great at one or the other, or mediocre at both. I mean, you can only cut the pie so many ways, right? There's only so many dollars to work with. So the reality is, if you're trying to maximize death benefit, that's one financial tool. If you're trying to maximize cash, that's a totally different tool. It's structured totally differently. Now, if you're trying to do both, frankly, you're going to be great at nothing and mediocre at everything. So our goal in most cases with clients is to maximize cash. Granted, sometimes folks have death benefit protection needs. They need to maximize their death benefit. And of course, we want to help them with those needs when they have those. Here's the analogy that I like to share. You can drive a pickup or you can drive a sports car. Now, they're both vehicles. They'll both get you from point A to point B. One has a potential of getting you there a whole heck of a lot faster, though, right? But the other has a different purpose. It can carry a lot of stuff. So if you're trying to move, do you want a sports car? Not very efficient. You see what I'm trying to say? If you're trying to get somewhere really quickly, the sports car is probably the better option. If you're trying to move, you want the truck. So my point is, which is more important to you? The question I always ask people, people start asking me questions about these contracts, these policies, and I always back up and ask the question for them is, are you trying to maximize cash or are you trying to maximize death benefit? Because there's a difference, okay? So how do you access, if you're trying to maximize cash, as the majority of our folks do, understand there's a death benefit, protection for loved ones, your business, whatever, that's important. There's a long-term care benefit in most cases, as long as you qualify at no additional cost. That's important because the long-term care costs just keep increasing. So protecting those protection mechanism tools you want to have, we address those, but our primary focus is to maximize cash with most of our clients, and that's the focus of your personal bank. A bank wants to maximize cash, right? Now, you can grow these passively or actively. What does a passive investor do? Basically, they contribute funds that earn its interest over time. They can get consistent growth, either fixed or index options, no downside market risk, have access to funds if and when they need them, long-term care, death benefit protection, tax-favored retirement for heirs. Those are all good things. Steady, consistent. They don't have to, limited stress. Some have more potential. The index has more potential growth than the fix. The fix is more consistent than the index, which is more important to you. Those are things we talk to individually, and determine which is the better fit. Okay, do you need the sports car, or do you need the pickup truck? You see what I'm saying? So that's with a passive investor. Now, I run into a lot of people that are more active investors, and those typically are your entrepreneur types, your real estate investors, all those types of folks who actively, many times use entities like corporations and LLCs, and they're actively managing, they're actively doing things to make money, okay? Even the IRS, and oftentimes, views them as an active investor. And what does an active investor do with a personal bank? Same thing, contribute funds or an interest over time with consistent growth, no downside market risk. But here's the big difference. Access funds for opportunities. You can access funds and still have the opportunity for the long-term growth without losing the compounding. And again, they have the long-term care, death benefit, tax favored for retirement. The key is you have the opportunity to access funds at a very low cost. Another option you can do, you can use the cash as collateral for a loan. You can go to a traditional bank, say, hey, I have this account with X amount of dollars in it, and use that as collateral for a loan. And depending on your credit and your situation and the interest rates, you can actually be earning more in your interest in your personal bank policy, more cash, than your interest on your traditional bank loan is costing you. If that's the case, you have what's called a positive arbitrage situation. You're earning more than what you're paying. So it's a positive arbitrage. That's an option. These contracts also can be sold. They have a cash value. As you build cash over time, there's a value there, and you can sell these as these contracts for cash. So again, you can access funds within it, loan it out, or sell it. For more information, contact us at yourpersonalbank.com or toll free 866-515-6280. Contact me. Love to sit down with you and share with you how this can enhance your financial future and change your financial life.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.